Well, I think there are 5 main reasons. Firstly, Asian firms, especially Chinese, are acquisitive and they need cash. And cash is relatively more expensive in the Asia-Pacific region. Secondly, of the $682 billion of global deal activities in the first 3 months of 2016, $101 billion, that's 15%, involved Chinese buyers. Secondly, MNCs are managing bigger operations and hence managing bigger risks in Asia. Asia-Pacific revenue contribution for corporates has risen 20% in 2009. Also, over the last 18 months, some Asian currencies have seen significant devaluation. For example, the Chinese renminbi has devalued some 15%, and hence receivables are worth less in companies whose financial statements are denominated in major Western currencies, causing profit to shrink. Companies need more cash as the shortening technology life cycle is driving increased investment in research and development also. And finally, a drop in retail sales in China, which is at a 2-year low, means companies need more cash to fund operations. In the recent China-Hong Kong Working Capital Survey, we find that every sector has a significant spread of performance. For example, in China, engineering and construction has a range of 49 to 292 days of net working capital. Out of 16 sectors, only 2 have shown improvements in 2011. If the existing working capital management growth trend continues, by 2018, the aggregate net working capital level in China will equate to 6,534 billion renminbi. Well, firstly, let me address the level of opportunity. We believe there's a 5% improvement potential in net working capital in China, and this will release 264 billion renminbi. And we believe in Hong Kong there's a 5% improvement potential, and this will release some 97 billion renminbi, that's 111 billion Hong Kong dollars. And how to realize this? Well, we think the best way is to focus on 4 key levers. Firstly, the identification, harmonization, and improvement of commercial terms. Secondly, process optimization throughout the end-to-end working capital cycle. Thirdly, process compliance and monitoring. And fourthly, and most importantly, creating and embedding a cash culture within the organization, optimizing the trade-offs between cash, cost, and service. And in which sectors? Well, first of all, we would say the pharmaceutical sector, where the median net working capital number of days is 154. Secondly, the industrial and manufacturing sector, where that median of net working capital days is 138. And thirdly, in healthcare, where the median net working capital days is 137. Well, every organization has to determine the optimal level of working capital based on their business model. However, there are some causes of high net working capital levels. Firstly, the lack of a proactive cash culture. Secondly, a lack of metrics and visibility and incentives targeting working capital. Thirdly, companies giving away commercial terms to get top-line revenue growth. Fourthly, having too much of the wrong inventory, but not enough of the right inventory. Fifthly, masking working capital performance by not paying suppliers. And sixthly, long cross-border supply chains and fragmented customer channels. Healthy companies can grow revenue and profit without destroying value. In times of low growth, and the growth rate of China's GDP is at a 5-year low, it's those organizations with a strong cash culture which can focus on the core business, which can emerge stronger and leaner, and be the first to expand and leverage their enhanced market valuation and positioning.